Welcome everybody. So let's get started where we left. If you have any questions, please feel free to type in the chat, or you can ask directly. That's totally fine. Just 1 or 2 minute recap. I mean, what we did was we last time started with why we should trade options, stocks versus options. We covered some basics of call and put options, and then looked at the screens and see how we navigate through the options in terms of selecting the strikes and number of contracts and how you place the order and things like that. And then I did go through some terminologies also that are very important, and we will go back to some of these today as we go through lecture session 1 and 2. And then we looked at the mechanics of long call, long put. These are the the starting kind of strategies that you would employ. So we did some work in a spreadsheet where we did some calculations. So what I will do today is actually first of all, I want to cover 2 very important topics, which will probably take 10 or 15 minutes of our time, and then I'll talk a little bit about some key takeaways from lecture or session 1, and then building on those things into session 2. So that's the plan today. Do I need to let people in, or somebody else is going to keep adding?
Okay, मैं सबको in करता जा रहा हूँ. There's no one.
Okay. I'm sorry. Yeah, so I just want. Okay. So the first thing that I would like to talk today is about understanding and optimizing leverage. That is the most important thing when it comes to options. First thing we want to know and understand is that what is leverage? How do you define leverage, right? So the best thing is to actually go in this little spreadsheet that I made. If you look at, let's take our example of NEO stock. NEO $20 strike. So I'm holding my strike price fixed at 20, and I'm looking at expiries, right? So if you go in the portal, you see that NEO has a lot of these expiries all the way into January of 2023. All these are available to you, right? One of them has 831 days to expiry. That's like a long leap option, which is 2-3 years down the road. On the other hand, you have that weekly call, which is only 5 days away, starting next Friday, right? So what I want to go through is that what I did was I plotted the days to expiration, right? Keeping my strike same, and I just put the data for the option prices, and I tabulated all of them here, right? And this is a very important thing because I want to explain leverage from here. So if you buy a weekly call, which is expiring next Friday, you are paying 1.63 times 100 shares is in one contract. So effectively you are paying $163, right? So your cost is $163, and you are getting an exposure on 100 shares of NEO, right? So NEO stock price is 21.18, right? So basically what this is telling you is that if you divide the 2 numbers, right, that's measure of a leverage. So basically what you're saying, if you divide these, it's about 13 times leverage. So what leverage means is that if you have money in your bank account or in your brokerage account, yes, then you probably don't need leverage, because what you will do is you'll buy 100 shares of NEO, and that will just cost you $2,118, right? But I don't want to do that. I want to play the game by just putting small amount of money, $163. If I win, I win. If I lose, I lose, but I don't lose the $2,000 plus dollars. Now, this is pretty good leverage, but the problem is there's only 5 days or 7 days, 2 days on the weekend, so I don't count them. So really 5 days that are available for you, right? But as you go down and buy more time for the same strike, $20 strike price on NEO, the more time you buy, your option price is gonna get expensive. So obviously, the more the time you ask for them to give you for NEO's 20 strike, you are paying more. And at some point in time, if you're looking at 3 years down the road, they will give you that option for $11.18, right? So if you do that division, you're only leveraging like 2 times, right? So if I buy the stock, I'm probably better off because I will pay 2,118 and I have unlimited time. I can hold this stock for 20 years, no problem, right? But this one is only going to give you 3 years or 840 days, and it's going to charge you, 11.18 times 100 shares. So you're looking at 1118, which if you divide them together, this is not good enough leverage. It's about 2 times, right? So these days, that if you buy stocks, you can get the brokerage companies, they actually give you 2 to 1 leverage, sometimes even 3 or even 4 to 1 leverage. But there's obviously some interest rate involved. But my whole point of showing you these calculations is this. As you go, keeping your strike fixed, 20 strike is what I'm talking about. Changing your expiries, you see how the behavior is. The option prices is increasing. Number one, it is increasing. The more time you buy, the more expensive the option becomes. But more importantly, it's the slope, it's the gradient of this, is that initially for 100 or maybe first 30 days or so, the monthly options, how steep that is. So yes, you get very, very cheap options if you don't buy a lot of time. So like I said, leverage increases as you are close to, you're only buying 5 days, so you get a lot of good deals. So it's a good deal, it's a good leverage that, like I showed you, it's 12 or 13 times. But the problem with that is obviously you're gonna after 5 days you're done with it. So it's dangerous but exciting. Why? Because you can buy more contracts. You can actually buy exposure on 1,000 shares, 1,000 shares of NEO. I mean, if you look at the calculation, you're talking, if you buy 1,000 shares of NEO, it will be, 1,000 shares, 21,180, right? On the other hand, the same type of exposure you do by taking 10 contracts would be 10 contracts. Each contract has 100 shares times the price which I'm going to have to pay is this. So you're by just giving 1630, you're actually getting exposure on 1,000 shares of NEO, and that's the power of options. Is that, but just for 5 days. If whatever reason NEO goes south and it actually drops below the expiry, strike price on the expiry date, let's say it closes at 19.88 or 19.99, you lose you will lose 100% of your money, right? That's the deal. But if for whatever reason it starts climbing up, you will make money very, very quickly. And that's the deal. And that's all the leverage. Why I want to explain the concept here. Now, what I suggest you is, like I said, if you are buying too much time for this, I would rather, and the leverage is only 2 to 3, go for, it's my advice is go and buy stock on leverage. Just by 2 to 1 or 3 to 1 leverage that brokerage will give you. Margin basically is what I'm trying to say. And if you really want to play risky, like I said, $1630 for that same 1630 will not get to even 100 shares of NEO, but you get exposure for 1 week on 1,000 shares, and God bless you if it goes to 23 or 24. You make money very quickly. And the calculation now. By this time, you probably know how to calculate that. But I'm not going to spend too much time on it. Most important thing is this area here is where people tend to buy options in greed because they think that this is very exciting. I mean, I know NEO is going to go up, and I'm going to put $1,500 right now for 5 days of exposure. And guess what? If it starts going up, I'm going to make real good money. I mean, I'm going to give you, time is running, but I'll give you a quick example of what I did this week. Just 1 minute here. So basically, I was sitting on Thursday looking at this stuff, and I just, for whatever reason, I just got a little bit greedy, and I wanted to try lemonade, right? So lemonade 60 strike, I bought just for $115, right? I just, let me calculate. So I just put, 1.15 times 100, and I just put, $115, right? I just said, okay, and strike is 60. And at that point, I believe, I don't quite remember, but let me see the time stamp here. It was about in the morning, 11:15 a.m. And I think it was about somewhere in 57 price range. And I think it was like 57. So it was a little out of the money, but I don't know, I had a feeling it's going to climb very quickly, right? And guess what? I wish I had held it till Friday, the 2 days, because if you go to Lemonade and you look at Lemonade closing price, this is a good example to show you the leverage, the power of options. Like so Lemonade actually crosses 67.81. So if I had kept it, and I will be honest with you, I didn't keep it that long. If I had kept it to 67.81 and my strike was 60, so I would make 7.81 per share. And if I multiply that number per share, I'm making 7.81 times 100 shares. I would have made 781 on an investment of $115, and that would have been a return of six. So basically, multiplying my money by 7 times in a matter of 2 days. I exited. I exited at hold on. Yeah, I just exited at 1.60. So I didn't hold it because I had a feeling that it will go up, but I made like 160. So I made $45 actually on an investment of 115. So I still made 40% return. When was the last time you guys made 40% return on a stock, naked stock? So that's the power of options. Otherwise, I would have lost $115 and I would have been okay. That's fine. I was wrong on something. But those are the power of that weekly options, and just wanted to show you how leverage works. You can, if I had done this with if I had courage to do that with 100, like 1.15. I mean, if I had done it by 10 contracts, then you can magnify that and held it till expiry. Just close the terminal and came back on Friday at like 3 o'clock with expiry. I would see my money grow 7x. But it didn't happen, so that's all part of the game. But anyway, so just interest of time, I don't wanna get hung up on this, but it was a good example to show you. Anyway, so one more thing I wanna touch base before we go to the second session is intrinsic and extrinsic value. We looked at it heavily. I mean, we talked about it last time that intrinsic value is actually the value that is built in. So let me clean this up a little bit. So if you look at any option, so let's we're gonna spend like 5 minutes on this. I mean, it's deserve more, but it's okay. So basically, you look at a $15 strike neo call. The total price you're paying is 6.88, right? But you know that there's in the money, which is the intrinsic value. And how do I calculate that? That's very important. What I do is that I look at the current stock price, which is 21.18, and I'm not actually paying anything for time because this is in the money. So 21.18 minus the $15 is exactly my intrinsic value. This is because if I buy it and exercises right away, I still get 6.8118 per share. And then they build a little bit of a time value, and then when you add those two, that's the total premium they're charging you, right? And they're giving you a leverage of 3%, three times leverage. So that's not, it's too much deep in the money. But as you keep going down on strikes, what's happening there is, and here I'm keeping the expiry same, right? It's all November, the 2020 call. Now, if you are going, as you go close to, so Neo was 21.18, right? So if you go close to 20, right, the premium now is actually decomposed in a different way. It is like there, because, okay, so let's calculate that. So now at a 20 strike, if you pick 20 strike, you know that only that price minus the 20, which is the strike price, is actually the in the money component of it, which is interest. So if I buy it and I all of a sudden exercise it, and that's why last time I said never ever exercise American options or these options. Always sell them in the market. And I'll come back to that point, that comment just in a second, but hear me out there, right? So I see in the grid that the 20 strike call is actually $390. And out of that, I am only that this is $118 is actual intrinsic value. And they are charging you $272 of that as time because I'm holding it for 4 weeks. The same concept here. I'm holding it for 4 or 5 weeks. That's why pay me that 2.72, and so that's an important trade-off there. You have to be smart enough to select where, and I'll explain you what to do, what not to do. Okay. So now the green line here is actually plotted the premium, And as you see, that this is a total price you pay. This is that column right there. Okay. So if you pay something that say 6.88, like I said here, see how little of that is actually the extrinsic value, and they're giving you a lot of intrinsic value, which is good thing. I mean, that's good that if you exercise it right away, you are actually buying something that is in the money. But as you keep going out of the money, remember this is 20 strikes, so we are at the money is right here. See what the trade-off is. Actually intrinsic value is 0 the moment it is. So if you're buying 21 strike, right? The problem with that 21 strike is that it's the stock price. No, actually 22. Let's talk about 22 strike. I don't have to actually calculate this one, right? So the 22 strike is not in the money because the stock price is actually lower than the strike price. So all the premium, all that 310 they're asking you is all for the time, for the 4 weeks you get. So in that lemonade example I gave you, I really don't do that, but I was greedy and I said I'm only putting $115, and that I bought it out of the money. So stock was at 57, I bought it at 70 because I didn't want it to. Ideally should have bought at 55 strike, but that 55 strike was $390 and the 60 was like $115. So I just said a little bet I will place. Okay. So bottom line is like the more out of the money you go, like this range here, you are paying a lot for that time, and you see that red curve increasing and that blue one decreasing, but the total overall premium is actually decreasing. So I would recommend you guys try to buy something that is close to the money. So if NEO was 21.18, this is kind of an area which is good enough. I think if you go too much deep in the money, like the example I showed you, what is the problem? The problem is you're not really getting leverage out of it. I mean, a stock that is $21 and you are paying like 6.88 for it, roughly about 3 times leverage. That's not good enough. So I would not buy options too much deep in the money. I would not buy too much out of the money because now you are only paying them for the time. I mean, on the 25 strike, they're charging you $270, $17 just to hold that for 30 days. So that's not what you should be doing. I mean, in my lemonade example, if that thing went south, my 115 would have been lost in 2 days, not even 1.5 days. So those are the options you should sell. And we will come back to that in session 4 and 5, like how to play out of the money options, how to play deep in the money options. But for some, most of you, the starting point is try to stay somewhere in the sweet spot where you're close to the strike. Your strike should be close to your stock price. So about 20, 19, 21 is probably okay. 22 is a little bit of a stretch. I don't like these intrinsic values to be 0. In fact, you should sell them and you should give that to the other guy. Okay, you take it and I will hold something in this area. We will talk a little more on that. Just in the interest of the time, I don't know what the questions. I mean, there may be some questions here. But,
Mukarram, question जो है सिर्फ एक ही है. How to choose the strike price when question is from Adnan. How to choose the strike price which give you highest percentage gain?
Very good. Very good question. So percentage gain is always going to be more attractive going out of the money. But the catch is there are 2 things. Percentage of quantity or magnitude of, so let me write that down. Magnitude of return is one thing. And probability of success is another one. What's the point of getting something that will make your money 10x, but with a probability of 5.05%? Would you take that bet, or would you rather take the? And that is, whoever asked that question is a really good question, by the way, because it just I should have explained it. So you don't. So okay, here's a bet: make the money 10x with 5% chance, make the money 5x with the 20% chance, or make the money 2x with say 70% chance, right? It depends on your risk appetite. As an experienced option trader, I would not do something like this because yes, it looks attractive. One of those if works for you, man, you will make money like so Polyton network, Eton. I was once studying the pricing and I found very bizarre thing. Somebody bought, it was a $40 stock back in, I would say 3 to 4 months ago, right? And I looked at a huge chunk of 37,000 contracts. And they were just sold at like few cents, like, 5 cents or something. Why? Because it was a strike of $75, right? So the chances, and now I'm coming to your answer, right? The chances of Polyton going from 40 to 75 in a matter of, and expiry was February. This was February expiry. Whoever that guy was must have become, he was right on Polyton. Today, Polyton is $123. And look at that percent. I mean, if he, whatever these are probably funds, hedge funds, right? So look at his return now. He's gonna make $125 minus strike was 75 on 37,000 contracts, and then multiply by 100 because every contract is 100. He's gonna make millions of. So yes, but how often that happens? It's your, if you really think that something is gonna go really high, then go for something like that. Yeah, that you buy out of the money options like the guy on Polyton did. So in that case, if you wanna make the money 10x, then go ahead and buy 2 points. So buy the 25 call. So what this does is this actually shows you a probability of success as well. So I'm going to show you something here. So let's say, no, not Lemonade. Let's say with Neo. Okay. Wait. So in Neo, if I select an out of the money option, 16, okay. So let's say 25 strike. This is very cheap now, 13 cents only, but you get 100 shares. So every $13 you put on 25 strike, you get 100 share exposure. Now I will make it up and you will see the power of this. If you are truly right on it, then you will make a lot of money. Okay, so the price will be $14. $14. Just doing the calculation. So every 100 share so you basically paying $14 and got exposure for 25 strike, right? Now, whatever reason, if it goes to 27 by Friday, right? Something happens, right? You will make a lot of money. How? Because your return would be, the strike was 25, right? So it'll be 27 minus 25. So you made $2, right? $2 per share. And let's say your investment, you actually didn't buy one contract. So when you place that order, do you guys want to do that? I mean, I can place that order. I don't care about a few bucks here and there. But if you buy 10 of them, right? And at 14, let's do 100, just for fun of it, right? 100 contracts, right? So 14. So what will be our price for 100 contracts? Would be 100 contracts, right? So let's do $1,400. Let's say that we're gonna waste that $1,400. But if it goes to $27, right? You will make $2 per share, and then you have 100 contracts, and then each contract has 100 shares. You'll make $20,000 on an investment of, you know better than me the type of return that you will just making your money 14x. This is not so, but the probability, now coming back to your, so yes, 14x return, 1400% return, but the probability that Neo will, what is Neo today? 21, yes. So what's the probability of Neo going from 21.47 to 27 is not as, it's not there, right? So chances are you're going to lose 100% of money, and that's why it's a perfect recipe of losing a lot of money very quickly. Now people play those kind of games. Now this comes back to our original discussion. You can do something like that. You can say, you know what, I don't want to play in 13x leverage. Like I showed you the 5 days expiry. And that's why I said, play somewhere in here, 5 to 6 times leverage. Yes, get like 100 days. So Neo can be $35 stock, and then, I mean, I don't know, we should spend more time on these things because this is fundamentals. But I mean, I can do a lot of those examples to you and show you how to pick up, how to select options, how to optimize leverage, how to play. I mean, I don't quite believe that one should actually just settle with the 2 to 3. This leverage is just not good enough. But on the other hand, what my friend asked the question here, is yes, it will make your money grow like 14x, but maybe settle down somewhere in here. Why not? 5x or maybe 3x. So this actually plots the probability of success. Let me analyze this trade. Analyze trade, and it actually gives you the so yeah, there's a 68% chance that this will be in the money. So then you could calculate your odds of success and then pick accordingly. I typically don't use these things, but it will tell you your probability, and there's a complex model here so they have their own volatility assumptions, and they will predict something that yes, this will give you that much percent chance of doubling your money in that much time. So again, this is all models. It could go wrong. It could be, but hey, everybody has a different way of using options. Some are speculators. They take a lot of risk, and I don't blame them. Yes, the guy with Polyton, I was laughing at him, and I actually longed that contract, the same contract, and then I said, it's not going to happen. This Polyton is not going from 40 to 123 in matter of 5 or 6 months. But he had the belief in it. He probably had some insider news, or it happened. But today, if you look at Polyton, it is I was looking at it that if I'd even bought like 100 contracts of that thing, it is to 123, and that Fabry call on Polyton, I think it was January or something. Yeah, this one was it. So in his 75 strike, now is see $50, and he probably bought for a few cents. So this is the power of options. I mean, you play however you think it suits you. That's my explanation. The way I play in the middle, I feel that this is the right kind of leverage and timing. And then, so look at your leverage, look at how much you're paying for intrinsic value, extrinsic value, optimize that. And that's why I said understanding and optimizing leverage. Happy to take more questions. Anybody else before I move on?
At the moment, there is no question.
Oh, there's a chat here. Okay, so registration. Okay. All right. If at some point in time we really get excited and we are like few of them, 7 or 8 guys or 10 guys, we can keep playing with these things, because we have tools. I mean, we can always, if this is more hands-on and examples help you find. If I don't want to go too much in theory because that doesn't help a lot, just at the beginner level, but eventually. So let me jump into session 2. We'll cover a few basic, few advanced things today, and then hopefully a very, very exciting things, vertical spreads, and we can actually start looking at those. But so first question first. What determines this pricing? I mean, somebody is putting these numbers here, right? Who does it? How do they make sense? I mean, how do I know that I'm buying something overvalued or undervalued? If somebody is selling me 5 days Neo call for 20, how do they come up with that 168 price? That question earned a couple of guys a Nobel Prize, by the way. Fisher Black and Myron Schools. Those two, Myron Schools was from University of Chicago, where I went actually. But that one question answer, how does this pricing work, resulted in Nobel Prize. You can Google it if you want. Okay, so that's not. I mean, but I'm trying to make it simple. I don't want to, preach you all this. But so the idea is this: basically, at this level, don't get into that Black-Scholes and complex. I mean, if somebody's truly interested in it, I have a link here. I put in the Black-Scholes model and explanations. I mean, you could see it's a very complex model. These days, even that is a little outdated. People use Monte Carlo simulations, and there are a lot of advanced methods on Wall Street that they price options. We're not going to get there. It's not in the scope of it. You can explore it on your own, but I will rest my case here. So option prices are determined by these inputs. First of all, most important, strike price. Volatility, how volatile a stock is. If I know my stock is like Tesla, for example, same, we'll show you example. Tesla moves a lot. Everybody knows that, right? Commonwealth Edison doesn't move a lot. It's an electric utility company, and it's not going to move, right? So there are some stocks that take large swings. So obviously the options on those will be expensive. Everybody agrees to that. Strike price is important. Deep in the money, like I said, we looked at that thing. Deep in the money options, 15 call is always going to be more expensive, and those out of the money are not as expensive. We all know that. But that's a big determinant. Strike, volatility, stock price, current stock price at 21.8 for Neo is an input in the model, but it's what it is. You can't control. I mean, that's the price that you see there. Risk-free rate, don't worry about it. It's generally not changing as much, but it's in the model. It's a determinant of the pricing. And generally, they are fixed, and it doesn't. Like if Fed for whatever reason hikes interest rate big time, all of a sudden, then it might change it. But it's just not. Especially for leaps, it's an important phenomenon. Like in 2 years, 3 years down the road, how the risk-free term structure of interest rate will look like. All that is important, but not at this level. I'm not going to confuse you all. Very important time to expiry. We saw that same strike, different expiries. These ones, if you go expiry, more days, more money, right? Here we saw same expiry, deep in the money strike, more money, right? So that's the intuition you have to develop. Dividend yield, don't worry about it. Dividends generally drop the stock price because you are getting some payout. So I have a little chart here. I mean, just this is all I'm going to cover with option pricing. I don't want to go in Black-Scholes models or Monte Carlo simulation. That's it. I took a full course on math models of option pricing. It's a total waste. But because we are not professionals in going in option pricing and all that, because we want to understand the pricing, but we are not gonna. These prices are given to us. We cannot change them. So what's the point? Understand them. That's good, but yeah. So increase in stock price obviously it increases the call price. If stock like Lemonade, it went up and stock price increased, and that's where I made my money. I bought it for 115, sold it for 160, made 45 quick dollars. So it went up in my direction, so it helped me. If it had dropped, put prices. So an increase in stock price hurts the put option. You know that why? Because you're bearish. You wanted it to drop, but it actually went against you. So that's why this is pretty obvious from the session one. Higher strike price on calls would decrease the price. We just saw that, right? So as the strike goes up, premium goes down, so the cost goes down, or price or cost to you. So I mean, it's all very intuitive. Rise in volatility, as I said, something like Tesla, calls and puts both are going to be expensive because it's a fantastic stock. It goes up by $60, goes by, everybody wants to play in that because they can make more money. So they're going to charge you more for that. And I have a very nice example. Let me pull that up now, and I will cover it. We'll talk about implied volatility, but see how Dropbox. So these, so Neo and Dropbox are about the same price, $21 and $20 stock. But everybody knows Neo is a lot more thrilling. So see the implied volatility on that is very high because they know that, and that's the pricing that I was talking about, is that they know this is a highly volatile stock. So those options would be expensive. Dropbox is not as exciting as Neo. So those pricing, although the stock, it's the same. So I'm talking at the money strikes, right? So about 20.5 for Dropbox, about the same at the money. And Neo, same. See how different they are for. And so that's what I was trying to tell you is a Snowflake or a Tesla or I mean, those are exciting stocks, and that's why people pay premium to get the options for those. So that's the whole point. So hold on. So basically, longer expiry. Obviously, I showed you. The more time you buy, the more money you have to pay. All that is very trivial at this point. Hike in, yeah, we talked a little bit about these, but these are lesser of the issues right now. I mean, higher interest rate. You cost of borrowing becomes higher, so people can't buy stocks on margin, so they revert to options, and that's why the option prices go up. And dividends also the same. When the dividend is paid, stock price goes down because you're getting a payout, and that reduces the call price. Not that important. Most important are the first four, which I explained, and I think based on the spreadsheet, you have some good intuition on that. So I'll rest my case here for option pricing. I mean, if I show it to somebody, they will say you taught something very fundamental, but I think that's a good. I don't want to.
So Mukarram, question follow from Adnan was, so sure. His question is, so 30 to 45 days far out provides good leverage. So that's what his comment is.
It's a decent leverage. I mean, people go for 1 to 10 leverage also. If you, this is like a roller coaster, right? If you like the thrill of it, go to the highest roller coaster and play and take the ride. If you are like me, who like the paddle boat in a lake, I'll try to play less risky. The more thrill you want, you have to go in. So you just, if you want to avoid the risk and don't want these exciting bets, then leverage of 2 to 3 to 4 to 5 probably is good enough. But now, one very, very important thing that I actually do a lot of times is thrill plus low money. And how do I do that? Okay, since there's interest in it, I'm going to show you. Okay, this is important. Okay, so what I will do is actually I will wait till Thursday, just like I did in the lemonade, right? So these options here, the time value is only 1 day, so they will actually become very cheap, and that's where you can get a return of 100% in a matter of minutes. But you can lose that 100 also in a matter of minutes too. So it's up to you how you want to play it. If you go to Thursday or Friday just before, sometimes I play two. So if I know that there's a day trip out there, that I see that this stock is gonna go, 1% move in a stock could double your money on a Friday in options. Just 1%. If you write on Neo that it will go from 20.5 to 20.7, and you are right on it, you basically may double the money right there on a Friday, because expiry is very close and these options are very literally time value is just nothing there, right? One of those days we could do a session on just look at these options on a Friday. Or maybe I'll take some screenshots and I'll bring those. If that's an important question, which I think is very important for an option trader, is that where do I play? And that's why I spent a few minutes on that. Like the lemonade example, 2 days only, I built a lot of leverage in it. And going back here, you generally buy 35, 40 days, play in a leverage of 5, it's good for an investor. Not everybody's like me sometimes, taking a day trip. If you want to you really think that Neo is a $30 stock in 6 months, then play buy 6 months as 140, strike at 3.44, go for it, right? If you think that I don't want to trust this thing and I just want to play 5 days, then you have 13x leverage, but then that premium will go away. So you have to, so for next week, here's the play. Your Neo is what? 21.47. So this 21.5, look at that one, right? So 21.5 right now is $77. That's very expensive. Why? It's out of the money, or it's actually at the money. And they're asking you for $77 for 5 days exposure, right? So let's calculate that thing. So let's look at that. So if on Friday night I bought that, so at the money, no intrinsic value, all time value. So they're charging me $77 to play the game, right? And Neo is 21.47 right now, and my strike is 21.5. So guess what? I'm not gonna make a dime if it expires 21.5 plus 77 cents. If it expires at 22.27, I just make my money back. That's all, right? On the other hand, the same at the money strike on a Friday morning will probably be only $20, 20 cents, or maybe sometimes even 15 cents. And then you look at it, then it will be like so you're only paying $15 to get exposure on 100 Neo shares. That's a leverage of 100 times 21.25. And you paid, just for 1 hour, you're making that trade. You paid $15. That's a leverage of, you know it, right? And this week, do me a favor, go and look at those options just 1 hour before expiry, like Friday at 2 o'clock Central Time. You will notice that they're charging 15 cents at the money strike. This same deal here, assuming that the stock price and strike price are very, very close, will be only 15. So that's called decay. And that's what I was trying to show you right in here. Yeah, the days to expiry, if it is like 1 day or half a day, it's just going to become vertical. So basically the point is, you can play, if you're a day trader, there's nothing good as options, because you can make your money convert into 10x or 20x in a matter of if that $15 investment, and whatever reason last 1-2 hours Neo started shooting, which it sometimes does, and picks up $1, let's see how much money you would have made. So it was 20.5, right? 21.47, let's say 22.47. It gained $1, right? Your strike was 21.5, so you made 97, but you actually paid this $15 also, right? So you basically made 82 on investment of 15. So that's what I'm talking about. Converting, doubling, not doubling, making your money grow 5x in a matter of a couple of hours if it takes that $1, and that's 4-5% movement. Sometimes that happens. Now, as you know, people looking at volumes of stocks and you know the technical charts and whatever. I'm not an expert there, so I do not want to claim that. But sometimes you see something moving sharply up, get in those options. You can get those options, but then the markets are efficient. They will increase the volatility right away. Sometimes there's a lag. Like Lemonade, I saw that it's a low. It's the volatility is still not rising, but I saw something special in it. But I did not trust myself. Otherwise, I would have made a lot of money on that one contract. 115, I converted to $800 right there. So I think I made my point here is that leverage keeps going to infinite small, like last like 5 minutes, those options are like at the money. So they'll probably charge you 3 minutes, 3 cents probably at that point, or maybe free, because it is only 5 minutes left. So, but don't play like that because there's issues there, right? But play in like 1 or 2 days, like Thursday. I actually one time made a model. I said, okay, $200 every week is all I can afford. Okay, I'm gonna come every Thursday, put my $200. Either becomes $1,000 or 200 is gone. I don't care. Next week I'll bring another 200. Right? You could play even with $50. You say that I'll bring $50. I'll buy that NEO contract for 50 just at 12 o'clock on Friday and wait 3 hours and have a very thrilling time. If NEO goes in, actually, then we'll talk straddles. Sometimes what you do is you buy that call also on the put also. Now you're saying that, okay, my cost is double. Either it goes very viciously goes from 21.5 to 22.5 or goes to 20.5. So sharp decline or sharp rise, I make money. So that's a straddle. And we'll talk about that. But I think I made the point. Any other questions before we
If somebody wants to ask a question, please unmute and ask the question. Otherwise, Mukarram will continue. All right, Mukarram, we do not have any question at this moment.
Okay, so let me see how much I can pick it up from here. Okay, so quickly I'm going to talk about these Greeks. So delta. The questions people asking is like, okay, a $1 rise in price of my stock, how much money my option makes, right? That's your delta, and it's always given to you. So you go there and you look at this column called delta. So what it's saying is that if NEO 20 strike moves $1 up, goes to 21, you will make $82 on it, which basically means that your option price, which is 1.66, will actually become 1.66 plus 82. So it'll be 1.66 plus 0.82. So that's how sharply it rises. Is basically delta. So see, the delta declines. So don't buy a delta of 1 because that's like buying a stock, and that's when this is deep in the money. Don't buy. I thought I had something on that. Hold on. Yeah. So delta, delta here, right? Yeah. So delta about 0.6 to 0.8 is good because you get what they call delta gain, right? So eventually, when the option becomes deep in the money, delta will converge to 1, which means that $1 movement in stock price results in $1 movement of option price, and that's what you want to get. Now, some people are crazy and they buy right here at the very low, out of the money. So they'll buy like a 24 call, which has a delta of 0.22, which basically means that if it goes $1 from 21 to 22, your option only gonna make $14. But delta is a dynamic thing. Every second, as the price is, they keep changing. And watch it next time. They keep. So my advice to you is buy a delta about 0.6 to 0.8 somewhere. Don't buy too low because then you will see that, oh, my option is not doing anything. Stock is going up. Every $1 stock picks. My option only give me $14. That's not what because you bought a cheap option. You only bought an option that cost you $17, and if that moves by 14, then that's actually not bad. But so don't buy deep in the money options because those are delta 1. Remember, delta is if my stock price goes up by $1, how much my option price will move. That's the ratio of that. That's the slope of your stock price and the option price. So you basically see, like, how fast, what's the relationship between those two. So let's go back to that. Now gamma is the second order effect. This is a second derivative. So basically, think about velocity and acceleration. A velocity is, okay, distance covered in time, right? So how much distance covered in time, but acceleration is how fast you are covering that. So how fast you are going to get gain in delta is the gamma. Gamma effect is I don't think it's very, very important for what you're trying to do. Is gamma gains are generally when your delta shoots up. I mean, it just quickly rises. It's a second order effect. So the stock price, the effect that the change in stock price, the relationship between stock price and the option price, it's one order higher derivative. So basically, it means that how fast that delta is actually going to move with the stock price. So it's less important. Let's not get into that gamma right now. Theta is more important. Theta is very important. It's a decay. By every 1 day holding that call option that you will buy, it's going to decline in value. If the stock price doesn't move, hey, you're losing those 5 days you bought. So the stock didn't do much, but you are losing time. So guess what? That intrinsic value, it declines for you, and that's where that problem comes. And that's what will be lesson section 5 is how to use theta decay to your advantage. So see, you are out of the money. You are not gonna get anything right now if you exercise it, or if you I mean, you're sorry, I did wrong. Intrinsic value means that if you today, there's nothing in it right now because your stock price is actually higher than the strike price is higher than the stock price. So a $22 strike collected on a 21.18 stock price means you're out of the money, which basically means that everything you're paying, all that premium, is just because you got some days from them. And every time the stock didn't move, this number is going to keep dropping, which basically means the premium will also keep dropping. So that's called theta decay. I have a slide on it actually, which will explain it better to you. Right there, this one. Yeah, so see, towards the end, that decline is very sharp, right? Because every day your option price, option value, or option price is the same thing, right? So it's gonna decline very, very quickly, and that's why I say have some time in your hand, unless you wanna play like somebody wants to make quick money on options, like weekly options. Then in weekly options, we prepared to lose. I bought this Bed Bath and Beyond, right? It didn't move. I did that on Thursday. On Friday, it didn't move. So guess what? I was in the red zone because I only bought it for 2 days, and that 2 days didn't move. So and then I just showed you a Neo, like that 77 cent today, 5 days. If it didn't move, that would probably be 15. That is all theta decay right there, because every day. So that's why don't buy in the red zone. Because the problem with that red zone is that it's going to decay very fast. But then it's exciting, leverage there, quick move in your direction, you'll make money very, very quickly. So that's what I'm trying to say is that try to buy in green zone, up to 120 days, 90 days, keep that much. That decay is not fast. 5 or 6 days, it's not going to decay much. But here, 5 days is a lot. So that's called theta effect. And we'll talk more because when you're looking at selling options, you're looking at that theta as a very, very important factor, because an option which has very high theta means it's going to lose the value very quickly. If I sold you that $77 Neo call, and all of a sudden I see that 15, guess what? I sold it to you, right? So I made that much per share, and it's 100 shares, so $62 I made. So theta effect we'll talk a lot, especially in session 4 and 5, because a lot of those income generating strategies are renting these options to give it to somebody else. You take it. You give me $77. I'll wait for it to decay, and if it shoots up, then you make the money and hedge it by having a stock position. And we'll talk about that later. But you got the idea of the theta decay. Hold on. So let's see where we are. We have a few minutes left here. Okay. Vega is another important thing is implied volatility. Like I said, the volatility. So before earnings, what happens? Everybody knows that 10 or 15% move is there. So that's when option prices go very expensive. So guess what? When Tesla is announcing its quarterly results, option pricing will shoot up because everybody knows it's gonna move like $100 here and there, right, or whatever. So that's the Vega effect. In the volatility, so these option prices, the Black-Scholes models and the Monte Carlo simulation, they bring in those. They know that earnings is there, so volatility is built there, and people are expecting that, so so that is a Vega effect. Increase in option prices because increase in volatility, or vice versa, is the Vega. Every 1% increase in implied volatility is going to increase option pricing by a certain amount, and that's the Vega. Rho is less important. It's the relative change by the interest rate. If interest rate, Fed hikes interest rate by 1% over next 1 year, especially important in leaps, then that 1%, how much that will change the value of interest. I'm sure that none of these guys here is gonna care about that. It's not that important, in my opinion, but theoretically that's the concept. So one more thing here, how to see them. Yes.
Can you please explain more on the increase in volatility at the earnings?
Very good, very good. So what happens is that, so implied volatility is listed here, right? So you see that 66. Now, if some news is coming, like let's say a biotech stock has an FDA approval coming, or somebody's announcing the earnings and all that. So you will see these numbers right here will shoot up, which basically means the higher the volatility, everybody wants to hold that option, because guess what? Somebody asked that question on, so the example I showed you, if I know that there's a very high chance that NIO will come up with this announcement that we have 1 million cars coming up or something, then that $21 can actually go to 30 in a matter of 1 week. So because of that, option pricers, they actually build that in the price, and they will be offering you those, the pricing here will be lot aggressive, because they know that announcement is coming and the implied volatility of the option is there, of the stock is increasing, which means you will get that bet now at an expensive place. Because, and think about logically, wouldn't that make sense? Because if I know that my stock is it says a 10, like IBM, for example, right? I mean, IBM is a boring stock in a sense that it doesn't move, 28% volatility, right? And let me see Tesla here. See. Yeah, so Tesla is 52% because but says it's a 1 week time. But NIO, for whatever reason, is more exciting. It's gonna move more, is what they're saying. In next 5 days, we expect NIO to show more percentage move, like it could probably go 10% higher or lower. So that's why the implied volatility built in those. So these options are actually expensive. In my opinion, these prices are a little expensive, but again, I can't say I've not followed the news on NIO, but so that's another thing you could do, is you can study this volatility and see something is there in the option market. I'm not pull something here, just a very, very quick, this is called option, unusual option, So this bar chart is my favorite. So you can go to that bar chart and you look at highest implied volatility. So you see some of those options there. Hold on, it's loading. Yeah, so see some of those are VXRT, for example. I mean, the applied were 211%. So let me pull VXRT or some. So yeah, you can see that. So that implied volatility. Now there's something going on with these stocks, and that's why this is high. I mean, you could go and see, like, so they will list down what you can actually go back. So GameStop, for example, GameStop at expiry, actually I'll probably trade it. 21 days left. 10:30 is expiry. 13 call is 100. So let me see GameStop, 149% volatility. So something is there in GameStop. So the GME 3-week option, this one right here, for a 12. Yeah, see, look at that. Something is there. Either the earning is coming. Look at these.
No,
You see
GME
that?
just announced Microsoft just announced partnership with GME.
Oh,
That's
sorry.
why.
Yes. Right.
Yeah.
So that's probably is gonna move. I mean, if that
Yeah, it moved already a lot, so that's why its implied volatility is very
so
high.
then sell it, and then sell it, it will normalize, so you make money on that. And that's the
Yeah.
topic of session 5. Sell
Right.
those, because if you know that, look, this is crazy. Why? Because $12 out of the money, 50-cent option is sold at 140 and 185. So that's a huge volatility built in it. I would sell it because I will hold the stock. If it goes up, I am still the winner because my delta is 52%. I will keep winning because I'm holding something at a delta 1. So my stock will keep making me money at delta 1, like you know how stocks work, right? But that option, if that doesn't move, that will drop very, very fast. I'm telling you, it will normalize. It will historic volatility of that thing will drop. So yeah, this we will talk in session 5 somewhere, how to make those strategies which are which we use the implied volatility, theta decay, some of those exciting topics. Any other questions? And I'll actually ask Sir Temur, what's the strategy here? I mean, I don't know. It's
The
you
basic
know,
term strategy is that we stick by the time of 60 minutes.
yes,
Many usually have to leave. But
right.
since we started late, if you want to continue for another 4 or 5 minutes, that will be
Yes,
fine.
please. So what I'll do is I'll finish off this, and then I'll talk vertical spreads next time. Then I mean, there's I don't wanna. What's the point of this going through quickly and not falling? So I think questions are welcome, and as I said, no, we'll have a tighter group of people who are truly want to learn this and have commitment. So I mean, I don't mind talking about it the whole night, because this is exciting stuff. Anyway,
We
so
still
let's
have
talk
three more.
about.
We still have 3 more sessions to go. The last session we can have like where everyone can go back and forth. We
Yes.
may have another 6 session with you. Where we just
We
cover
will
some.
keep right, exactly, based
Yeah.
on, and I'll try to speed up. I see initially things move slowly, but I'll pick it up at some point. But allow me like 5 minutes to wrap it up, and then we'll. So implied volatility, we talked about it a little bit. Is that they basically back calculate this based on the option pricing. You can actually do it yourself too. One thing I wanted to show you was the option price calculator. So I didn't cover option pricing as such, but you can just put that neo current price is 11.47, exercise price was 20, and you can put expiry days are 5, and you say interest rate these is 1%, dividend yield does not pay dividend, volatility was what, 60. Neo Neo 5 days option 20 strike is 65% roughly. Is that right? 65%, right? So you go there and you put 65, rounding that's to 2 degrees. Okay, calculate. It will give you the price of the option. See, it's actually pretty darn close, 1.62, and there you see it's 1.66, 1.7, so it's about 1.68, so just 6 cents off. So you can always calculate without getting into Black-Scholes model and other complex model. You just use some calculator and it'll tell you what is the delta of option, and this is just a calculator you could use to price the options, but it's anyway, so you could play with it. So implied volatility is actually again a measure of how volatile it is, like I showed you. Generally, when markets drop, like back in February, March time, when COVID-19 strike, implied volatility or VIX index went through the roof, like 70, 80, from like all of a sudden like 12 or 13. VIX is like a star, it tracks the volatility in the market. So yeah, when the markets drop sharply, implied volatility increases, option pricing becomes expensive. You sell the
Yeah.
options then.
There's a follow-up question for you.
Yeah.
Question is, at what point you decide to exit the trade and take loss? If your trade goes south, do you stop out at a particular?
You asked a very good question, and I'll take a minute to answer it. It's based on your commitment to the trade. If you are like me, I always early, just like a stock, there's no. So in Lemonade, I saw 160 minus 115, $45 made on an investment of, $45. So that's three. That was a really good, 33% return. So I exited it, but I could have held it till Friday and made 700% return. So it really depends on you. I would say, just as a rule of thumb, when delta factor is gone, delta becomes 1, and you are now actually in this range leverage wise, that your option became too much deep in the money, you try to roll it up. And maybe, so if NEO goes, you hold 20 strike and it goes to 25, then it's deep in the money. So then you roll it to 25. If you want to still stay bullish and you think it's 30 and 35, increase that leverage again back up. So lever it up again rather than playing at the average of 3. So one thing is that if it moves significantly your direction, you exit it. On the loss side, I would say that, I mean, you could use stop loss and all that. I don't quite believe in options. You should do that because the bid-ask spreads are so bad, and a lot of those options that they get executed crazily. So I would say that it's really, if it's $100 committed, you say that, okay, I'm gonna play the game till the end. Or if you say, I just like a stock, I mean, you decide, because you're gonna actually see these option pricing literally move here by the time, right? By the second, like stock prices move. When NEO goes 21.6, these numbers will change every second. So you decide at that point that generally I made a good money on it. You exit it. I mean, I myself gave an example how early I was out of that lemonade trade. I could have stayed till Friday and made $800 out of $100, but I didn't do that. So it's really up to you, how much belief you have in something. Did you have the news that help you make the decision, or it's really it's a determination based on your commitment to the trade.
Sir, a quick question here.
Sure.
You were saying something about rolling over the options, like you wanted
yes.
to.
So here's what you will do. If you are in NEO 20 call and NEO is at 27, sell the 20 call and buy the 25 call. So you are back in. So just like today at NEO 21.47, you are holding 20 call. When it is $27 or $26, hold the 25 call. Because of the delta effect, you don't want to play delta 1 because it's not a good leverage, like I showed you here. It's a leverage of 3 to 3 or something. So why would, because then it's just gonna be like taking my $700 and giving me a delta of 1, which is
just like a stock, yeah.
Yeah, just like a stock. I mean, I would lever it. I will roll it to 25 just to take that, because in 25 strike you get 2 or 3 times more contracts. So if your option is 688, if you buy the one here, you can actually have it say exposure on 200 or 300 stocks for the same money. So that's what I'm trying to say, is that you roll it to a higher strike if you're still bullish on it, and people do that all the time.
All right, last 2 minutes. Let's roll up.
So last 2 minutes. Okay, so let me quickly see what I can do in 2 minutes. So yes, so I made my point. Markets drop sharply, implied volatility goes up, sell the options. Then give it to other guy, you take it, okay, and hold the stocks. If the implied volatility is low, you keep looking at VIX, okay, and see if really high options are cheap, buy them, especially the leaps, buy and hold them, or 100 days, 90 days, take some time and buy the options. And we'll talk more in section 5 on that. Last slide is volatility smile. At the money, options are always gonna be lower in implied volatility. The moment you go out of the money or deep in the money, volatility will start killing you, and you can see that in that little there's a little I had. Look at the drop box, right? So implied volatility is 79% for a deep in the money call. Starts coming down, comes to like 35, and then goes up, back up. So at the moment you are like, the strikes are like out of the money or deep in the money, that is a smile. So if you see the volatility smile, is that the options that are deep in the money strike, and out of the money they are the implied volatility is killing you. So try and stay at the money is a better option. Decay we already talked, and then we are gonna, yes. So I think we can pick up from there next time. Any other question? Happy to answer.
So high implied volatility.
Ask the question.
Sorry. So high implied volatility is not good for you for buying the options like calls or puts.
They're good sometimes, because if you believe in that volatility, I would buy the stock, sell the option. Why? Because stock has a delta of 1. It will, if it goes up, your stock will make you deliver. It will deliver for you, right? But that option, if it holds there for 1 day, the decay in that pricing, like GameStop, it's just gonna kill it. Now, if it goes up, you are covered. You gave that option, you sold it to other guy, you hold it, I'll wait and watch, right? That's the better approach. You sell it. Don't What about the leverage at that time? Hold the stock, but sell the option. And those are covered calls and puts. We will talk about that.
I've been doing covered calls on some stocks. So.
Yeah. But we'll talk about that. Maybe I should have put that before spreads, but that will come sooner or later. So.
All right. Thank you.
Any other?
All right. Yeah. Any other question?
Hey, Mukarram, quick question. So what I understood was, let's take an example of NEO. So you are saying that if you are in a call for $20 for the strike price, and NEO calls go to, NEO price goes to $25.
Yes.
You should sell the call which was at strike price for 20 because because the delta is gonna get 1, and then decay is gonna kill you. So you should sell that call, and if you think it's still bullish, you should buy another call with 25 strike price.
Yes, the only correction here is delta. Theta will not kill you. It's that delta will actually become 1, and theta effect is already almost gone there because you are completely holding intrinsic value. That chart right there, you see that at your extrinsic or time, you're only paying 70 cents. You're pretty much everything is intrinsic. You exercise it, even well, never exercise it because you lose the 70 cents.
Yeah.
But see the fact, you're down on leverage now. So re-lever it, go back to 25. You should still want to hold it. So keep rolling it is what I'm trying to say.
Oh, got it. Thank you.
Last couple of minutes. Any question? All right. Thank you, Mukarram. I think so we are good. We will pick up from right here.
Yes.
And all those members who joined us, it is the same link. If you want to go register for the next session, it's the same link. And all those who missed the last session, you can basically just email me or Hassan Rahman, and we will give you the access to the previous session. You just have to donate that $5 to NUSTIAN. That's it.
All right, guys. Thank you very much. Enjoyed talking to you, and I look forward to meeting next week.